Hello and welcome to a very special edition of The Money Show where we're going to be talking about the debt side of the investment because there are a lot of opportunities that are available, be it on the equity side or on the debt side, as well as when you're looking for a safer investment options, then you also go for FDs. But today we're going to be discussing about the nuances of the debt instruments and how they can actually offer you better returns than FDs and what are the nuances that you should be knowing about the debt side of the instruments. So let's try and find an answer to all of that with a very special guest of mine today onto the show, which has been focusing more on the debt side of the instrument, has been telling and guiding our viewers that how in the longer run, in comparison to the FDs and the debt instrument funds, you can actually have better returns. And to answer and guide us more on that, we have been joined by Vijay Mantri, Chief Investment Strategist and co-founder of JRL Money. Hi Vijay, it's great to have you on the show. First of all, if we, because we had you almost a year back and we had almost the same discussion that between FD as well as debt instrument, how should one go about? But in the past 1 year, we have seen the FD's rate improving a little bit. But because you have been doing a historical analysis of how these FDs and debt side of the instruments and rates have changed, so at this point in time, why you still believe that debt instruments still offer good opportunities in comparison to FDs?
So if you look at a year back, we have been recommending debt mutual fund from since 2023. And if you see last 1 year return, the 1 year return has been very good, around 7.5% for most debt product. 1 year back, FD rate was 6.5%. So even for a 1 year period, the outperformance is 1%. When you look at FDs, whether it's a bank FD or corporate FD, one need to understand that the bank borrow at the lowest cost among all the entities in the market, be it individual, be it AAA companies, be even central government. So for instance, if you look at 3-month bank FD, it is 4 to 4.5%, but 3-month T-bill is 690. So where one should go and invest their hard-earned money. If you look at current account, saving account, the rate of interest is 0% to 4%. The call money offer is 670 basis point return right now. If you look at 1 year back, 1 year return of equity arbitrage fund has been 7.5%. Tax efficient, 660 to 675, tax free post-tax return. Why this happened? Because most people believe that fixed rate offered is a great way of investing. But actually market linked instruments are much better, much more efficient. And if you look at the horizon of 20 to 30 years, on an average, a market linked debt product, which is a debt mutual fund, will offer you 1 to 1.5% higher return over a 30-year period. Lots of people don't understand that. I have seen people haggling, we want to invest in direct mutual fund, we'll save 1%. Fine, you save 1%. But 15% of the household saving goes into FD and they are not bothered about it. You and me do not have any option but to pay indirect taxes, to pay direct taxes. But on investment, we have option how to defer or not to pay or pay at much lower rate of interest. I don't know why people are not even looking at that. So I think investors need to look at an option outside bank FD, and then they will figure out that they can earn 1 to 1.5% more return than the typical bank FD.
But Vijay, the point being that if one goes for an FD, the bank generally doesn't ask you to take the money out. They just go ahead and then renew your FD on their own, and people are happy doing that. But when you're saying that 1% extra return is what you could generate, so that the alpha generation is over there, and over the years, how can one benefit through the compounding, and how long can people stay in the debt instruments? Because when we talk about the rate cycle, then we do take it in a short-term period. But in the long-term tenure, how should one strategize its investment in debt?
So it's a very good question. Generally, people believe that that FDs are for shorter duration. But when you look at FD, how does people look at FD? They don't look at time period. They look at where we're getting the highest return. So 3 साल का ज़्यादा अच्छा लग रहा है, 2 साल का ज़्यादा अच्छा लग रहा है, we'll invest money there. But FD decisions are not short-term in nature. FD decisions are long-term in nature. They are 30-year-old, 30 year long. Because for instance, more fixed deposit get renewed than new fixed deposits are being created, as you yourself mentioned. When you start earning at the age of 25, your first FD may be 25,000 rupees. But at the age of 60, our FD could be 5 crore, 6 crore rupees. So FD decisions are very, very long term in nature. And I'll give some two simple statistics. HDFC Mutual Fund did a study of 1990 to 2022 over a 32-year period. Wheat prices, tur dal and petrol, their prices compounded at 7.5% to 8.5%. Now tell me, for 32 years, which debt instrument delivered this kind of investment performance? Only two. Birla Income Fund, which got launched in October 95, for a 28-year period is delivered 9% compounded return. The second is Kotak Gilt Fund, which got launched in December 98, completed 25 years of performance, delivered 9% compounded return. People don't understand the difference between coupon rate and compound rate. So I'll just take a very simple illustration. I was part of the HDFC Mutual Fund team when we launched HDFC Liquid Fund in October 2020. October 2000, that fund completed 23 years. In a 23-year period, the fund generated 6.9% CAGR. But suppose I convert them into simple rate of interest, simple interest rate come close to 15% per annum. So people don't understand the difference between compounding and coupon rate. In mutual fund, your money compound. There's no finite time period. Ek saal ho gaya, now I need to take money out and redeploy. In debt mutual fund, you can continue as long as is possible. And why very simple thing investor need to do, whenever they are looking at investing in debt mutual fund, don't look at historical return. It has no meaning. What they need to do, a very simple thing, look at what time period they are looking at investing. Look at what is the FD rate offered for that time period and compare with similar maturity debt mutual fund and get the YTM, will get all the answer. It's very simple, and the money compound, no annual taxation. You can do loss harvesting, which is not available in any other instrument, which is available here. And by the way, people chase return in debt. It is not they go for safety. Only when they can exit, they go for safety. Else they go for chasing return. And one more thing investor can do, which debt mutual fund can do effectively for you, or equity arbitrage fund can do for you. You invest your hard-earned money into equity arbitrage fund, transfer the gain into equity mutual fund, or invest in a debt mutual fund and transfer the gain into equity mutual fund. You are protecting your capital, and the gain transfer create lots of alpha. So I'll give a simple illustration. Same. HDFC Liquid Fund, suppose you invested 10 lakh rupees in October 2000 and just transfer the gain into HDFC Capital Builder, you have generated 13% CAGR compounded over a 23-year period.
Oh, that's a great number.
Exactly, and without facing a volatility even for a
in
day.
the markets, yeah.
But I don't think people are looking into these things. But it is very, very important that you need to look at these things. If you want to become champion, you need to think. Even the smallest thing you eat, you have to be extremely careful.
Okay, but Vijay, if somebody is watching our show and gets convinced that between FD and debt mutual funds, he should go with the debt side of the investing, then for the benefit of our viewers, any of the top funds that come to your mind at this point in time where people can go ahead and look at buying, and or also if you can guide our viewers that what are the top key criteria they should look at when they are analyzing any debt mutual funds? Because for equity investment, we have a lot of factors, large cap, small cap, other type of schemes are there. But how to go about the debt side of the investment?
Very simple, figure out the time period for which you're investing. So suppose your time period is up to 7 days, call money fund. And you can pick out any fund houses call money fund, because the portfolio is identical across, because it is a lending between banks. Okay. And right now it is 670. Beyond that, 7 to 90 days, look at the liquid fund. And in debt mutual fund, just look at top fund houses only, don't go beyond that. And one of the best proof is that what happened in 2018. In 2018, there are some fund houses gone through challenging period, but there are some fund houses which has not got impacted at all. So ICICI Mutual Fund, HDFC Mutual Fund, SBI Mutual Fund, and Bandhan Mutual Fund, or Sundaram and Axis, these are 6 fund houses which didn't have any problem on the debt portfolio side. I'm not saying other had or not, but I'm saying 6 I remember didn't have anything. So if you ask me where one should be putting money, 0 to 7 days call money fund, 7 to 90 days liquid fund or SBI or HDFC or ICICI. 90 days to 1 year, you could look at floating rate fund, again ICICI, Nippon, HDFC. 1 year beyond, we need to look at equity arbitrage fund, where I think the Invesco is doing very well, Edelweiss has done very well. 2 to 3 year plus money you could look at in ICICI, all season bond fund, you could look at HDFC Great Opportunities Fund, HDFC Corporate Bond Fund, Axis Strategic Bond Fund, and Nippon Corporate Bond Fund. All of them had a great track record. Just do that.
Okay, so that's for the benefit of our viewers that they also got the top recommendations from Vijay as well. But Vijay, before we let you go, this year is expected to be quite volatile. There are a lot many big triggers that the markets is looking forward to. Hopefully, it turns out to be good for investors. But we have elections in India and US. There's a rate cut expected. So because if you have done the analysis historically, a couple of sectors don't tend to perform that well. So which sectors do you believe that could be the winners for 2024, and which sectors could take a back seat at this point in time, and how should one strategize their investing given these big events?
So in my opinion, first of all, people need to examine balanced advantage fund and multi-asset fund. That will be much better for them.
Okay.
Sectorally, I think banking and financial services industries looks in a great shape, because for the 20-year period, they outperformed Nifty 50 and Nifty 500. But in last 4 years, Nifty 500 delivered 19% CAGR, Nifty 50 delivered 16% CAGR, and BFSI delivered only 10% CAGR. All the balance sheet problems, everything is behind them. And when we talk about BFSI, it is just not the bank, NBFC, stock exchanges, broking company, RTA, fintech platform. We have so many varieties available, insurance companies. So BFSI, in my opinion, is a great shape right now. And last couple of years, they suffered because two leading names, HDFC and Kotak, had their own challenges, and FIs were selling. And FI had a higher holding in these stocks, so there was a continuous dumping from their side.
Okay.
So that is the one reason. And right now, I think the FI money, when the FI money comes, I think the BFSI will be the biggest beneficiary. The second sector, in my opinion, is going to do very well is going to be healthcare. And healthcare is just not 1 year story. Healthcare is a 20-year story. I'll give you 2-3 very simple things. On an average, a patient in US get 2 to 3 tests. In India, 2 to 3 tests done. In US, it's 8 to 10 tests. All the new doctors which are coming, they are relying more on science rather than just आपकी नब्ज देख के इलाज बता दिया. Biosimilar, drug manufacturing, hospital, health insurance companies. So it is actually a mega trend. We have 23 crore people above 55 years of age. आप नूडल खाना बंद कर दोगे, बट आपकी बीपी की दवाई चालू हो गई तो फिर जब तक So I think to me that looks very good. Where I will be really cautious right now is SME segment and small cap. We believe small caps are, I don't think there's a great idea as in a small cap.
Okay.
And if you look at big fund houses, if you look at any small cap fund, they have 5 to 9% stake in many companies, and these companies are not very liquid. So if there's a challenge, I would see on SME segment definitely. I'll just segment on the small cap. Large cap, I think, is in very good shape right now.
All right. With this, we'll let you go on that, Vijay. Thank you so much for joining us today on this particular discussion. It was great having you, like always. But with this, viewers, it's time to slip into a very short break in this edition of The Money Show. Don't go anywhere. We'll be right back. And then it's the time to take note of all your portfolio-related queries by yet another guest. So stay tuned for more. Welcome back to The Money Show, and viewers, this is the time where we take note of all your portfolio related queries that you send to us on an everyday basis, because we understand that there are a lot of funds available and you often get confused where to invest your hard-earned money and whether your earlier investments are the best ones for you or not. But you can write to us and we will try to get the expert advice on that. You can write to us on a WhatsApp number that is on your screen. Also, you can also email us on themoneyshow@etnow.tv. So let's get started for today, and to answer your portfolio related queries, we have our guest Kaustav, who is the Director Fund Research at Morningstar Investment Advisor India. Hi Kaustav, very good evening, and it's so great to have you on the show. Moving with the first query that we have, and this one is coming from Manohar, I beg your pardon. So Manohar says is that how much should he invest in SIPs for a 2 crore corpus in the next 10 years? How can he go about investing his money so that in the next 10 years he has around 2 crores of rupees? So what will be your advice on this? He didn't share his age or the other risk profile parameters, but what's your sense that how can he go about it?
Sure. Hi, Srishti, and thanks for having me on the show. So I think it's good that Manohar is thinking about a certain corpus and a goal that's 10 years down the line. I would say a reasonable time frame, not an excessively long time frame, but a reasonable time frame. So I think when I think about constructing the portfolio, what I would recommend to Manohar is obviously you'll have to start with monthly allocation through an SIP to build your corpus, and this amount should be about 70,000 rupees per month. Largely start with an equity portfolio with a little bit of liquidity built in, but predominantly about 70% large cap, 30% in mid and small caps would be an ideal allocation. So you're not taking on excessive risk, and step up your SIPs by at least 15% each year. So I think that's very important when you think about constructing your portfolio and doing an SIP on a regular basis. The other thing that I'll kind of bake into the calculations is, remember, it's a goal 10 years down the line. Now 10 years, like I said, seems like a reasonable time frame, but it's also important to think about volatility that exists in asset classes such as in equities. And if I just share an example, if you're an investor sitting in the year of 2010 and said, hey, I have a 10-year horizon, so let me invest in a 100% equity portfolio and stay invested through the period, right? Great. Come 2020, your portfolio would have been significantly up, no doubt. But obviously, we had an event like COVID where we saw a market correction of anywhere between 35 to 40%. You would have lost a large part of your portfolio. You might have met your goal before that, but you would have actually, the portfolio value would have dipped significantly due to this event, right? So what we recommend to investors is as you come closer to your investment goal, and when we say closer, typically about 5 years out, you start gradually reducing your equity exposure, moving into fixed income. And do it what we call a glide path approach. So gradually reducing that and maybe get it to like a 50-50 when you're closer to your investment goal. So I think with the 70K SIP with the 15% allocation, starting with 100% equity and then slowly reducing that, as I said, after year 5, should be able to achieve his, on a conservative basis, his 2 crores in 10 years with this kind of strategy.
All right, so that's the advice coming in from Manohar. But course of the last question that we could take in the show today is coming from Saral RL, and he says that he has invested 50 lakh rupees in Motilal Oswal Mid to Mega Strategy Portfolio Management Services Fund, and it's now at 61 lakhs. So indeed, he has earned some return on this. But should he continue to stay invested or make a shift in this one? And he's also considering the market to touch 25,000 after the elections, and there would be a huge market correction. Would it be wise to stay invested or book out profits and invest after the correction? Because a lot of viewers are just curious to know that how this volatility can kick in. But if in his already done investment, that is of Motilal Oswal Mid to Mega Strategy Portfolio Management Service Fund, what will be your advice on this, Kaustav?
Sure. So, obviously, I don't know the construct of the rest of his portfolio, so I'll specifically comment just on this fund. So, a couple of things to keep in mind. So this is predominantly a small and mid-cap strategy, currently about 80% of the portfolio, and that's obviously the mandate of the strategy. So it is a focused small and mid-cap strategy. 80% is in small and mid-caps right now. So I would, urge Saral to think about what is the overall construct of his portfolio, right? Because we know that small and mid caps can be volatile. We've seen volatility in the recent years also in these counters. So we wouldn't recommend anything more than 30 to 40% tops allocation towards small and mid caps in your portfolio, even if you say have a 10-year investment horizon, right? So that's the first thing that Saral needs to think about, that where does this fund fit in his overall portfolio context, and obviously exit if he's over allocated to the small and mid cap category, right? That's one thing. Second part about market levels. Honestly, I wish we could predict market levels. No one knows where it goes, but I think it's important from an investor to think about two things. One is don't think about short-term market levels because it's very hard to predict, right? There's so many market forces at play, and we've actually done some studies which showed us that, if I just look at markets over the last 10 years, and we broke it down into monthly return series, just 11 months out of this 120 months, which is less than 10% of the time, accounted for the entire outperformance of the market over cash, right? So if you were not invested in those particular 11 months, you would have actually underperformed even liquid funds, right? So from an investor's perspective, it's important to stay invested. What you can focus on is your asset allocation, right? And if markets have run up quite significantly, and hope that they touch that 25,000 level soon, then what I would urge every investor to think about is, if I'm over allocated to equity, over and above what my suggested allocation is, then I should book some profits and bring it down to the level that I intend to be at. I think that's the strategy that investors should use, rather than trying to really time the market, because no one can get it right.
All right, so that's the advice coming in for Saral. But Kaustav, with this, we'll let you go on that. Thank you so much for joining us today onto the Money Show and helping our viewers with their portfolio-related queries. But with this, viewers, it's time to wrap this edition. It's a goodbye from me and the entire team who put the show together. Thanks so much for joining.